Okay, so we're going to be starting the adjusting process today. And again, adjustments are necessary because it's simply a process of double checking our accounts to make sure that all the revenue that's supposed to be recognized is indeed recognized for that period. And all the expenses that should be recognized in a particular period are also recognized. So this adjusting process is basically sort of a double checking type of process that we're going through. Learning objective 2 looks specifically at accounts that we would classify as deferrals, which means we're going to wait or postpone or delay recognizing the revenue, or we're going to wait or postpone or delay recognizing the expense. And so this is our focus today. Okay. So deferrals are either assets that after we use them can be expensed. The book refers to those as prepaid expenses. Deferred revenue starts as unearned revenue, which is a liability. But after we deliver the service or deliver the product, it's no longer unearned, it's actually earned. It should be in our revenue account. So, but again, we have to wait. That's the deferral piece. We have to wait until we use the asset to expense it. We have to wait until we deliver the good or service before we recognize the revenue. That's the waiting, postponing part. There are a lot of assets that once we use, turn into expenses. Okay. And you already know several of them from the earlier chapters. You know about prepaid insurance. You know about supplies as well. You've also heard about buildings and equipment. So you're familiar with those accounts already. What you might not be familiar with is there are other prepaid assets. There's something called prepaid rent, which works like prepaid insurance. You're paying your rent up front, so it's your asset until you need to pay it, and then it becomes an expense. And there's also an account called prepaid advertising, which works the same as prepaid insurance as well. You are paid up front for advertising for a period of time, say maybe 6 months. When you pay for that up front, it's your asset. But once the month has gone by and that advertising has been used, then you have an expense. Okay. So these are, again, prepaid expenses are assets, start as assets. After we use them, we can expense them. Okay. All right, so just to tell you how the adjusting entry works. And again, it's an entry. Every time you see the word entry, you know it's going in the journal. Okay, because everything in accounting starts in the journal anyway. The adjustment part, again, is double checking. Okay, if we used up a portion of an asset, like supplies, it should be expensed that period. So the adjusting entry is we are going to debit the expense account and credit the asset account, whether it's supplies or prepaid insurance or whatnot. It works the same everywhere. Debiting the expense, specifically insurance expense or supplies expense, crediting the asset, specifically supplies or prepaid insurance. This is how it would work. Okay, so the debit to an expense account increases the expense. The credit to the asset account lowers the value of the asset on our books because we've used it. So there are 3 particular prepaid expenses that this looks at that you have to know. You have to know these. The first is supplies, which should come as no surprise for many of you. As you know, Sierra Corporation purchased $2,500 of supplies in October, very early in October. Okay. Um, but now we've come to October 31st, the very end of the month, and they want to make sure they're double checking their supplies to see whether they've used any of those. If they've used any of those, they can expense it. Well, they have to count up, right? There's an inventory count, so physically counting the supplies. And lo and behold, there's only $1,000 worth of supplies on hand. This little phrase "on hand" simply means you still have that. It's right in front of you. Okay, still in your possession. Obviously, if you started with $2,500 worth of supplies and you only have $1,000 worth of supplies at the end of the month, you've used a lot of them. Okay, so the portion that you used can be expensed. So at the end of every period of time, in this case, they're only looking at the end of the month here. So October 31st, you would have a supplies expense for the amount that you've used. If you started with 2,500 of supplies and you ended with 1,000, you've used 1,500 of those supplies, and so that's what you can expense. Debit to supplies expense, it's a very specific expense, right? Crediting the asset account means you're lowering the balance in that account to show what you really have. You have $1,000 in that account. That will get you there. That's the journal entry. Once you actually post it in the ledger here, you'll see supplies would be adjusted balance of 1,000 because that's exactly what you have. And the adjustment to supplies expense would be new as well. You'd have a supplies expense of 1,500 to show at the end of the month. Okay. So supplies is one that you need to know. The good news is these adjustments are the same. So every time you see supplies being affected at the end of a month or the end of a year, it's always going to be a debit to supplies expense and a credit to supplies. When we're doing adjustments, these accounts are always paired up. Let's move on to insurance. Insurance is the second account you need to understand, gets looked at before we do any of our statements, because if we've used any of this insurance, it can be expensed for that month or that period of time, right? Well, as you know, Sierra Corporation at the very beginning paid $600 for a 12-month policy. Okay, so starting in October all the way through the following September. Okay, coverage began October the 1st. And so basically speaking, every single month that the insurance is used, basically $50 of that insurance has expired because the $600 is for a 1-year policy, which is the same as $50 per month. $50 a month for 12 months is $600. So every time every month goes by, so in this case, the month of October has gone by because we're on October 31st, we can expense $50 of this insurance policy. Okay. And it looks like this. It's a debit to insurance expense, debit. Prepaid insurance is an asset, credit. So again, that's recognizing the expense, which again, expenses are on the income statement, which is the very first statement we do. That has to be accurate. That's why we're going through this adjustment. And of course, we lower the value of prepaid insurance because we've used it. Our insurance policy is no longer worth $600. It's only worth $550. So once those are done in the journal, they'll post in the ledger. So now you'll see the asset account has an adjusted balance now of $550. And that insurance expense now shows up with the $50 balance in the ledger. So that's the second one that you need to know. 2 down, 2 to go. Not bad. The third is regarding depreciation. You don't have to write it, but you can if you want to, if it helps you. Um, I'm going back to the previous slide. Yeah, okay. So you know all this stuff all this stuff comes directly from your book. This is on page 158. You can see it in action as well. Again, your book is an incredibly important resource in this class. And all I can say is everyone should be reading and using the information in the book because it's exactly what you need to know um, for the homework and the exams. And also, I'm using the PowerPoint slideshow that you have available to you on Wiley. I'm using the student slideshow. So I'm not using any resources that are different than what you have. Plus, I'm going to be posting this lecture later on. Okay. So again, lots of resources in the class. Got to use them. This last piece here, when you buy equipment, when you buy a building, when you have machinery or vehicles or things like that, they don't last forever. They have a life for a business called a useful life. How many years can the business use this equipment before it basically, craps out? You need to get a new one, blah, blah, blah. So every time a business acquires property, plant, and equipment like buildings or vehicles or equipment, the first thing they have to do is figure out how many years they're going to be using it for business purposes. So think about UPS. I mean, how many miles do they put on those trucks? Trucks do not last forever. They can have a very long life, that's for sure, but they don't last forever. And so, and of course, now where we have many, many more people ordering online and more things delivered by those types of vehicles, they're in use more and more and more. So, at some point in time, they're not going to be as useful to the business. They're going to break down. They're not going to work quite properly. And so the business needs to plan for that. So everything has a useful life. The wonderful thing is that this useful life is in years. Okay. So a truck might, last 4, 5, 6, 7 years. They might not, and every business will plan it out differently based on their business model, the usage. There's a whole bunch of factors that goes into deciding that. And they are going to pay a pretty good penny for that truck up front. So what they can do is they can actually start allocating the cost of the truck, in my example, to something called a depreciation expense. Okay. But it's a slow drip because you can't just depreciate the truck all in the same month, all in the same year, because you're going to be using it for several years. And so it's going to depreciate very slowly over a long period of time. And so this is what depreciation is about. And this is how they use the depreciation expense account in a business. Um, uh, Construction plan, that anything that's required to build something, and we're going to get into the chapter 9. You're going to learn specifically how the value of assets are determined in the property, plant, and equipment area, and then how depreciation works. You're actually going to be calculating the depreciation for those things. So if it's a part of the cost of the building, for example, which construction, plumbing, things like that, roofing, is, it would all be reflected in the value of the building on the balance sheet once they put it there. So you'll learn about that in Accounting 102 for sure. guaranteed. So you don't have to, the good thing is you don't have to calculate depreciation here in chapter 4. You'll be doing that later in chapter 9 in Accounting 102. So that's the good news. So they're going to give you the depreciation on an annual basis. So in this case, Sierra Corporation has a bunch of office equipment, and they have calculated, they've given you the information that it's $480 of depreciation per year. Well, we're only doing, in this case, we're focusing on the month of October. And so $408 a year divided by 12 months would give you $40 per month. So this $40 per month would simply be the depreciation of the equipment for Sierra Corporation. The entry works a little bit different than others. First of all, there is a depreciation expense account that would get the debit. So that's a piece of cake. What's different about this is we don't actually touch the equipment account. There's a new account that's created underneath equipment that's called the accumulated depreciation account, which basically, as the word suggests, it shows the accumulated depreciation on that equipment over the years. So it simply accumulates. If it's $40 a month, it'll be $40 a month for 5 years. So 2.5 years into it, your accumulated depreciation will be blah. They will show up in that account. Okay. And so this is actually what's called a contra asset account. It's actually an asset account, but it has a credit balance because it shows how much of the equipment has been used, has been expensed toward depreciation. So this is how it would look in the ledger. Accumulated depreciation account would basically piggyback the equipment account. It'd be right next to it. This is the amount of money we actually paid for the equipment. This is the actual amount of the equipment we've actually depreciated and expensed so far. And of course, depreciation expense is an expense account, and now it has a balance. So this is what's a little different about depreciation, is we don't actually touch the actual asset account itself. There's a new account that's created, accumulated depreciation account for the equipment, and that shows where the adjustment is. That's important to understand because you might have heard of something called book value. Might have heard of something called book value. A lot of people say, well, what's the book value, particularly of a used piece of equipment, maybe a used car. A lot of people want to see if they're looking to buy a new car, they might look at what their book value of their car is. Well, how is that determined? Well, it's the value of the car when you bought it, brand new, less the depreciation, the accumulated depreciation on that car over time. And that becomes what we call a book value. So what we see in on balance sheets for equipment, okay, is the book value of the equipment, the amount that we paid for it minus the amount of depreciation that has been expensed over time, thus accumulated over time. So this is something called a book value, and that's where the term this is what the term means. So this is important to sort of understand how that works. Okay, so basically your book tries to sort of wrap up all your prepaid expenses. Again, they're assets that you have to wait to use, and then you can expense. Okay, so that adjusting entry of debiting the expense and crediting the asset is what we've been focusing on here. Okay, what if you don't do it? What if the adjustment process was totally skipped? We didn't double check these accounts. Well, the assets would look like you had more. So we call that overstated, the assets. Your assets would look more valuable than they really are. And worse is you'd be missing a lot of expenses, which means that if you're not, your expenses would look smaller than they are, which also means your profit would look bigger than it is. So the adjustment process really helps us avoid a real financial catastrophe in bad numbers, in really bad numbers here. On the other side, there is a deferred revenue, meaning we have to wait to claim the revenue. This impacts a lot of companies because a lot of companies actually have unearned revenue. In other words, a lot of companies have customers that pay them up front for things that they're waiting to receive. And so that's what unearned revenue is, remember. And unearned revenue, as you know, is a liability account. It's on your balance sheet as a liability because it reminds you that you owe the customer for what they've already given you the cash for. Okay. So it affects landlords and other things when um, they have rent that's collected, unearned rent revenue. Of course, the airlines, maybe not these days as much, but in normal cases, you pay for a ticket up front, right? And that's recorded as unearned ticket revenue at the airline because they owe you a flight to wherever you're going. Okay. If you still have any magazine or other subscriptions, you're paying up front usually for the year. You know? And so that is also unearned subscription revenue, and because they owe you the magazine, so they owe you whatever you paid for up front. And anytime you go on things like a cruise or a vacation that you need to pay up front, that's unearned revenue. And so, or even purchasing tickets to a sporting event or a concert, you pay for that way up front, well before it happens. That's a liability to that company. They owe you what you paid for. So they have to wait. That's why it's a deferred revenue. They're waiting. Okay, they're waiting. But once they wait and it becomes a new month, then that rent is no longer unearned, it's earned, which means it should be in revenue. Once you do take off on the plane, like I always like to say, it needs to take off, doesn't need to land. Um, that's revenue now. It's no longer a liability. They have you on a flight going where you're going. Okay. As soon as that, as soon as the boat pulls off on a cruise, and that's what you paid for, that's their revenue now. That's what they promised you. That's what they were waiting to provide. So the problem is here is it's still a liability. No, it should be a revenue at this point. We need to move it off the balance sheet and on the income statement as revenue because now they've actually earned it. Remember what revenue is. They've actually did the work. They actually did the work. They actually delivered the good, right? So the adjusting entry needs to be made. And how it's made is we are going to lower the liability. The liability in this case is unearned revenue. Right. And we are going to credit the revenue account because by golly, now we've earned it. If we've earned it, it's revenue and it should be on the income statement. Okay. So it's a debit to the liability account, unearned revenue, a credit to the service revenue or whatever revenue account the company has. Okay. So here's the illustration, and this is the very last one that you have to know. There's 4 deferrals that you have to know. This is the 4th one. So you probably remember our Sierra Corporation very well. There's a guy, or I'm just going to call him a guy, Arnox, that early in October gave Sierra Corporation $1,200 cash for guided services to be completed, in the next few months. As you probably remember, Sierra Corporation recorded that as a debit to cash and a credit to unearned revenue. Well, at the end of each month, they're going to see, did they earn any of that stuff? They have to double check. Did they earn it? So now we're at the end of October, and they did an evaluation of anything they did for our Knox during that time. And it comes out that they actually earned $400 of the $1,200. They actually did perform services for our Knox in the month of October. Well, there's a problem because this $1,200 is sitting in unearned revenue, which is a liability. They don't owe them that much anymore. So they have to do the adjusting entry, which they do by debiting unearned service revenue. right? That lowers the liability account. Now they only owe $800 worth of unearned revenue. Well, if they adjusted it, that's because they earned it. If they earned it, it should be in service revenue. It should be on the income statement. And so the adjustment increases the amount of revenue they had for that period of time, the month of October in this case. Okay. So again, the reason why we do the adjusting entries for the unearned revenue account um, is quite simple, right? We debit our unearned revenue, credit revenue. What if we didn't do that? Well, it looks like we have a lot of debt. It looks like we owe a lot. So our liabilities would be overstated on the balance sheet. And worse on, those revenues would be missing from the income statement. And if there's missing revenue from the income statement and your profit comes from the revenues, then your profit looks lower as well. That would be a problem. Okay. So this leads us to our last page here. If you're in your book, it's page 162. So this is on page 162 in your book. Okay. And here we have, we're at the end of March. We have a company, Hammond Company. They have all these types of accounts listed here at the end. And now they're really doing a double checking process. They're actually analyzing the accounts. They found four things. Number one, they've used $100 of the insurance. Number two, they counted their supplies. There's only 800 of supplies left. Okay, you're going to notice, right? They used up a lot of those supplies. Third thing is they have equipment and it depreciated $200 that month. And the fourth thing is they looked at their records and they actually performed $4,000 of services. Now look, they owed $9,200 of services to their customers. They actually did $4,000 work to earn that. So now we're preparing the entries based on what we just reviewed here in Objective 2. Okay. So the first thing is insurance expires at $100 a month, which means that this amount should be lowered by 100 and the expense should be increased by 100, which is basically what we do with this journal entry. It should actually be listed. What I don't like about this is it should be actually dated the 31st of March because that's the date that we're doing it. Okay, again, this usually happens at the end of every month, and it certainly has to get done at the end of every year. But as you see, it's a debit to insurance expense, a credit to prepaid insurance. It's always going to be this combination of accounts when we adjust insurance. Supplies on hand means we still have them, 800. Well, if you started with 2,800 and you have $800 of supplies left at the end of the month, you've clearly used the difference. So you can expense it. And again, I would add the date here. This is not, the slide's not very well done, in my opinion. But on the 31st of March, we would have a supplies expense for 2,000 and a credit to supplies of 2,000. And this would be the adjusting entry. This pair of accounts is always used at the when we do adjusting entries. Okay, this is a pair that's always used. Equipment depreciates at $200 a month. In this case, they just give you the amount of depreciation. There's nothing to calculate here. So in this case, we just, again, we'd write the date here, depreciation expense of $200. I disagree with this as well because I would actually say it's accumulated depreciation for equipment, and that's a little EQ there. And so a credit to accumulated depreciation for equipment. This is the actual name of the account that should be used here. And the very last thing they did is $4,000 of this amount that they owed was actually earned. They actually did perform that. So they don't owe this anymore. They owe much less. Well, it doesn't happen without an adjusting entry. And the adjusting entry again at the end of March would be a debit to unearned service revenue, which would lower this amount. and credited to service revenue, which would increase the amount of revenue there. And that is the story for today. Questions?